Okay, this should be fun for you to learn, especially in episode 42 of the ICT Mastery Mentorship, because we're going over a new PD array. The PD arrays that you only know so far are, I wouldn't say liquidity, but an order block and what is it? Order block, mitigation block, not necessarily breakaway gap, because that's a type of fair value gap that's used in a totally different context. But the PD arrays you know so far are order block, fair value gap, and mitigation block. Here's a new one, the liquidity void, a very, very versatile PD array whenever it forms. It's definitely one of my favorites because of the amount of opportunities it can provide while it's forming and even after. It's an amazing PD array. I'm going to show you. In short, the liquidity void is basically a monstrous, when I say monstrous, I mean just an egregious expansion. And when I say that, you might think, "Oh, this is a displacement. That's egregious." You might think that's insane. No, a liquidity void is like huge. Like it's quick, it's huge, and it's just monstrous. Okay, yeah, I swear, don't clip that. That sounds really, really wrong, but I'm talking about liquidity voids here. Okay, I'm not talking about that thing. I'm talking about liquidity voids. But it's just huge. It, yeah, I don't think I can record this. I put too much emphasis on the huge part. But it's just a gigantic displacement. Like it's just okay. You know what? We're just gonna keep going, man. I don't think I can do this anymore. Anyway, here is I can't take myself seriously. Oh god. Okay. Here is a liquidity void. Okay. Liquidity voids typically form after accumulations or consolidations or whatever you want to call it, sideways movement. That's when they normally form. Normally. But the only way they can form outside of accumulations, like after prices just not moving sideways, if you get what I'm saying. It doesn't have to be displacing before then, but it just has to be going in a certain direction. The only way it can create a liquidity void is if it's significantly larger than the previous movement before. So, for example, if price was going down, I don't know, let's say 150 points before then, over the past like hour and 30, and 9:30 opens up and it drops 900 points within 30 minutes in a couple candles, then yeah, that's a liquidity void because it's significantly larger and significantly faster than the previous move in the same direction. You know what I'm saying? So it's pretty simple. Anyway, we're gonna go over this one first because this is very, very simple. We have the original consolidation here, or there's multiple names for a consolidation. There's price imbalance, not imbalance like a fair value gap, but in the word in, the letter N, I-N, balance, price imbalance, and or consolidation, and or original consolidation, which is for a totally different concept that you don't know yet. But we call this the price imbalance. Price is imbalance, it's calm before the, I don't know, before the explosion. I guess you can call it that. But this will be your original consolidation if I can find it. What the? I think I have it as a text box. My bad. Yep, my bad. I got it as a text box. Oh, here it is. Accumulation. Okay, so you got your accumulation, right? You see these gigantic candles here? One, two, see that? You're probably like, this is it? It only moved 200 points. The thing that makes this a liquidity void is how quickly it moves and how much it moves. It's mainly how quick it moves. I'm not gonna lie, because you can have this same, what is this, 300-point movement across what, like 10 candles, and it'll still move 229 points. But it's mainly how quick it moves. And when I say quick, meaning how many candles is it doing it? So you see how before then it's just very calm. The waters are nice and calm. Then for some reason there's a whole thunderstorm, and then the market just drops extremely fast too. Two 30-minute candles, well, that's still pretty fast, but you get the point. It's just very quick and speedy or lightning fast. You get what I'm saying? But this isn't really a good example. I'm just now looking at it now. But let me go find something else for you. Hold on. Let me go find something else for you. Yeah, so this would be a liquidity void. This is a good example too. This is what I was talking about earlier about how it needs to be significantly, stronger and larger than the previous move and quicker than the previous move. So as you can see here, price was already going up, but it was going up slowly. It was going up a little bit. How much? 103 points, a little measly 103. But look how many bars it took to do that. Just look here. It took 10 bars because we're on the 30-minute, but that's 5 hours. That's a pretty long time. That's maybe fluctuating through Asian and going into London. Maybe London going into pre-market. So that's a long time. Once 9:30 comes, hold on, I'm getting Discord notifications. Got to turn my volume down. Okay, there we go. When 9:30 comes, we explode through the roof. One candle, one singular 30-minute candle, in which we deliver. What's that? 188 points. Okay. Like I said earlier, it's mainly based off how quick. Okay. It can still be this same amount of points that was delivered here, 103, but it just has to do it insanely fast. That's what really creates the liquidity void. Because this same move right here, 188 points, this same move could be delivered across 10 bars if it wanted to, and it wouldn't be considered a liquidity void. But since it moves so fast, and even if it's close to the same amount of points as this move here, it's still a liquidity void. I'm going to show you what the liquidity void actually is. So the liquidity void stops getting created when there's no more fair value gaps getting created. Okay. In which this is the only fair value gap right there. That candle's high, that candle's low, second candle in the middle, encapsulating the gap. There's your fair value gap right there. So when I say there's no more fair value gaps being created, I mean consistently, like fair value gap after fair value gap after fair value gap. They don't stop getting created. That's what should happen if the liquidity void keeps going. If it's like a liquidity void that's just going and going and going, it'll create multiple gaps continuously. It won't stop and just do a singular candle, do a couple candles, consolidate, then make a new gap. It's not going to do that if it's a liquidity void that wants to keep going. But since this is the only gap that's there, this is the liquidity void, but not exactly though. Let me show you. Since this is a bullish, okay, listen to me, a bullish liquidity void, the actual range of it would be from the first candle of the first fair value gap within the liquidity void, in which this is the only gap. It'll be from the opening of that first candle to the third candle of the last fair value gap, in which this is the only fair value gap. So the third candle of the last fair value gap, or only fair value gap in this case, would be this candle right here. The close of that candle, which is right here, would be, let me get it for you, if I can get it. Where's it at? Liquidity void. Here it is. Would be your liquidity void. Now, now. The only reason this is a liquidity void, this range here, or why this particular range is, drawn out here, is because of these two candles primarily. You're probably like, obviously, right? But there's something different that can be done here. If this candle was a bearish candle, right? If it was just completely flipped over and this wasn't here, right? Let's say that level I marked is the close of this candle instead of it being the opening. If this was a bearish candle, the first candle of the first fair value gap, if the liquidity void is bullish and the first candle is bearish, you would want to mark it, listen to me, you would want to mark it from the opening. I mean, not opening, but from the closing of the bearish candle of the first fair value gap, if it's a bullish liquidity void. Why? Because when you're doing that, for example, right, you have, let's just put it directly like this. You have a bearish candle, right? The next candle opens up. If it opens up and it wants to go higher, it has to start at the previous candle's closing, okay, which is the previous bearish candle's closing, which will be this here, if it was a bearish candle, and it has to go up and overlap the previous bearish delivery in that candle to go higher. So when you start from the first candle's bearish close or the close of that bearish candle, you are truly getting all the buy side delivery that the liquidity void is delivering, because it's just from the I really can't explain it, but let me just explain a little candle closure to you. I'm sure you get it, but I just have to make sure you understand it. It's just to be the best teacher possible, I have to make sure you understand it, okay? So, here's a perfect example right here. This right here is the closing of the candle. That right there. That part of the body is the closing of the candle. This right here is the opening of the next candle, okay? So, if this was a liquidity void, for example, you would set the bottom of the range or the bottom of the bullish liquidity void right here, because this is the start of the buy side delivery. You see that? See that? Look at the bodies. That's the start of the buy side delivery going up. See that, right? So if this was a bearish candle, in which I wish it was, so I can, really show it to you, you would highlight the close of the first candle of the first fair value gap. If Jesus Christ, run out of breath. But if this was a bearish candle, but it's not. Now, that was all of explaining, but I have to explain the other candle too, which is basically vice versa. If this was a bearish candle, but it's a bullish liquidity void, you would highlight the, what did I say, the open? Yeah, you would highlight the open of this candle because you're getting the last point of buy side delivery before it stopped creating fair value gaps. Simple, right? Because the last point of buy side delivery before fair value gaps weren't getting created anymore was at that point there. No more fair value gaps were getting created after this line right there. See that line? No other fair value gaps after that are consistent. So the last point of buy side delivery would be in this candle right there. But where within this candle? At the close of it. Well, at the open of it, if it's a bearish candle, in which I have to tell you this so you understand it once we go over different confluences. Because this might be just a 25-minute video because liquidity voids, they get deep like that. But that's how you would define or identify your range, your total range of the liquidity void, because most people don't teach this. This is real ICT stuff. This is coming directly from the source. So just know that you're learning the good stuff. Please remember that. So that's a weird looking liquidity void, even though it's not one. Anyway, here's another one right here. Here's one right here. There we go. And this is that example I was talking about. This is a bearish liquidity void in which the only gap is right here. So it's within these three candles. 1, 2, 3. We had the consolidation before it. Let me mark it as accumulation. Hold on. Give me a minute. We got the accumulation. Then we have the expansion lower. Okay. Since this is a bearish liquidity void and the first candle of the first fair value gap and or the only fair value gap within this liquidity void closes as a bearish candle, you would want to mark that from the open. Okay. Since the last candle of the last fair value gap and or the only fair value gap of the liquidity void is bullish, you would want to mark the, what did I say, the open? Yeah, the open of this gap. So think of it as this. If the candles close as the same directional status as the actual liquidity void, meaning if the candles close bullish and the liquidity void is actually bullish, for the first candle of the first gap, you would mark it from the, what is it, the open of it. And then for the third candle, you would mark it from the close of it. Simple. And if they are opposing the directional status of the liquidity void, you would just vice versa it around. So for example, if this was a bullish candle, you would mark it from the close. If this was a bearish candle, another bullish candle, you would mark this from the open, in which I did here, because that encapsulates the all the sell side delivery that occurred here in basically just highlighting the true imbalance, the true liquidity void that's really here. So there's a lot of explaining on it because I had to drill that in your head real quick. Hopefully you understood it. I might have to show a little bit more examples on that, but you get it. This is the entire liquidity void right here, in which liquidity voids, I forgot to mention this because I was explaining that so much. I went on that rant for like 7 minutes, but this is good knowledge, so pretty appreciative. Um, liquidity voids, I think, are the third strongest PD array from what I know. Let me see. Let me go to the compendium. Remember, use this, people. I didn't make it for no reason. Where's my PD array matrix? Here we go. Where is it? The liquidity, yeah, it's the third strongest PD array. This is a PD array, meaning price can use this. And when I say use it, it can use it as a reference point. So that does not mean if price hits a liquidity void, you should short off of it. You should never do that. Never do that. I would not advise you to do that. Now, you can use equilibrium and quadrants on the liquidity void. I forgot to mention that. It is the third strongest PD array, meaning price can use it as a reference point. You refer to it, use it for confluence, whatever you got to do. But do not, and when I say do not use this as an entry point. Don't. Just use it for confluence. It may say, ICT may say it's a PD array, but don't. Especially on the lower time frames. If you're doing swing trading, maybe. Maybe. But on the lower time frames, 15-second, 1 minute, 5 minute, don't even try it. I'm not even saying this from experience. I just know you will get tore up. Okay, so just listen to me on that one. But liquidity voids, there's a reason it's called a liquidity void. It's because there is a void of a specific side of liquidity. In this case, since this is a bearish liquidity void, meaning there was only sell side delivered within this range that I highlighted. So we can mark this as liquidity void. And since I just told you that, what that basically means is price will tend to fill in this liquidity void or temporarily use it to continue where price is going. So, for example, if we apply quadrants to this thing here, see, boom, boom, and then bam, pull that out. And I don't know if price dropped any lower after this. No, it proceeded to fill it first. But there's two things price can do. If it really wants to keep going lower or just keep going in the same direction of the liquidity void, it'll refer to these quadrants and the equilibrium and consequent encroachment stuff like that. It'll refer to it to keep going lower, or its primary reasoning for even existing is to get filled. Okay, that's what it should do primarily. But obviously, if price wanted to go down, it'll refer to the equilibrium, the quadrants, or whatever, and it'll tend to leave a part of the liquidity void open to continue going lower because you want to get that short term rebalance. I call it. Well, not even I call it, but ICT calls it. It's like a short term offering and basically a short term handshake that says, okay, yeah, let's do this. Let's make this part of the gap balance. That's basically what's going on there. So that's what'll happen if price wants to go lower. But since it doesn't, it wants to go higher, it's going to tend to fill the entire thing because it's literally a magnet in price. Within this range here, this is probably the largest magnet you will ever see. There is only sell side delivery in between this range. No sort of buy side was offered for 197 points within that range. So, since it does it so quickly and at such a high magnitude so quickly, it has to fill this ASAP. Does it do it? Yeah. It definitely does it as soon as possible. Definitely. Accumulates. Next day opens up, boom, fills it. That's the ASAP I'm talking about. So we're probably going to go over two more examples so you can get the candle closure part and how to actually, highlight the liquidity void because some people don't really know how to do that. They say they know how to do it, but they really don't. Anyway, let me see if I can find one for you real quick. There's been a lot of liquidity voids, and they've been getting filled back to back to back to back to back. Let me see here. Hold on. Would this be a liquidity void? Yeah, it did it pretty obnoxiously. I'm not gonna lie. And then, yeah, this is liquid. This is liquid. Whoa, we're gonna keep that in. We're gonna keep that in. I'm not gonna edit that out, but we're going to keep that in. Here's another liquidity void. We do not, well, kind of have an accumulation, but the point of accumulation kind of stops right around here. It would be this entire range, but I don't know. What do you say? I kind of think it's an accumulation because it's still within a little channel or range here, or channel as retail calls it. But hey, I guess we can mark it as an accumulation just to think of it as the retail mindset, but it really does not look like one. Here we go. This liquidity void has multiple fair value gaps and just more than one. And when I say just more than one, just two. That's it. It only has two, which is this one and that one right there. That is your liquidity void. Well, not liquidity void, but the gaps that are inside of the liquidity void, in which the liquidity. I cannot. That's such a tongue twister. See, teaching these videos or like recording these back to back to back really makes my tongue twist because these terms, liquidity, like how are you supposed to say that repeatedly? Anyway, no, where did it go? I just reset my chart by accident. Here it is. My bad. I reset it by accident. I'm so stupid. Here we go. So this one has only two fair value gaps, sadly. Wish it had more. It'll be a bigger one. Pause on that. The range of this liquidity void, finally, without me making any mistakes or having any tongue twisters, would be from this candle. Okay, let me hide the drawings real quick so you can see it better. Would be from this candle to, why is my mouse doing that? From this candle, Jesus Christ, to that candle there, in which we'll get the specifics of each candle in just a second. So, first candle of the first fair value gap of the liquidity void, a lot of the, but first candle, since it's bullish and is in the same directional status or closes as the same directional status as the liquidity void, you would highlight the open of the first gap. Oh, brought back the drawings, but that's fine. So first candle, since it's the same, closing or same directional status as the liquidity void, you would simply highlight the open of the first candle. If I can get it, look, there we go, liquidity void. Here we go. Now here's where the opposition begins. Last candle of the last fair value gap of the liquidity void. Jesus Christ, a lot of these, but I have to say the of these so you'll know what we're talking about. Since this candle is opposing the directional status of the original what is it? Original liquidity void or the original direction of the liquidity void, you would mark the opening of that candle, which would be right there. Boom. Let me just mark it as liquidity void real quick. Hold on. There we go. So we now have our liquidity void. Boom. There we go. So we have the two fair value gaps within it in which it refers to it. But let's just delete those real quick. Let's delete them. Oh, well, what am I doing? I did not place that correctly. My bad. I'm so slow. Here we go. We can see here that price refers into the upper quadrant. 1, 2, 3, 4. Then it finally jumps higher. And does it ever break that high to hit that mitigation block? I don't think it does. I mean, it does eventually break that high, but I don't think it ever comes down to refer to that. Yeah, it almost never does. But you get the point. It respects the lower quadrant to temporarily go back higher, in which that magnet is still there. Okay. So we filled some of the liquidity void. So from here to here, moving that down, that is now the liquidity void because we stopped creating gaps right here. Let me remove the quadrants. We stopped creating gaps on that candle. Okay. And I forgot to mention liquidity voids must contain fair value gaps within them. Must. If they don't, it's not a liquidity void. Okay. Real simple. In which we just go over, well, not go over, but went over multiple examples that had fair value gaps within them. So you should understand what I mean. But since that candle stopped creating fair value gaps, or there was no more fair value gaps after that candle, any other candle after that that goes into the liquidity void gets, I guess you can say, adjusted. The range gets changed. So since that's the deepest price went into it, you would mark it from here to here, or readjust it from here to there, which is your new liquidity void. And if we pull this out, price eventually, it may not want to do it then, but it eventually digs into that. Pretty nice, isn't it? Yep. And fills the whole thing. Barely going below those equal lows down there. Want to see that? Sure, let me mark it for you. Barely. Wow. Whoa. That really just caught me off guard. Look at that. That's crazy. Fills the liquidity void. Hits the buy side liquidity right below it because this is a giant imbalance in itself. Hits the buy side liquidity. Well, purges the buy side liquidity. Mark that as liquidity purge. And then just jumps higher beautifully. Absolutely amazing. In which there's still another gigantic liquidity void here. Should we go over that? Should we? I guess we could. Why not? You can click off the video. I'm sure you know the concept by now confidently. I've taught it pretty well already. But if you want to click off, or if you want to keep learning, you can stay here. Or if you think you know it, you want to go study it, train yourself on it, you can click off. But I'm going to go over one more example. We have an accumulation for it. Very, very small one, but accumulation is accumulation at the end of the day. Big enough. Pause. Because I swear some people are going to clip that and take that out of context. I swear. No one has done it yet, surprisingly. I've said a lot of sus things on these recordings, in which some I haven't even released because I said some egregious things, like really. I haven't released some of them yet because I was like, should I release this? This might ruin my reputation. Not in like a bad way, but I've said some out of pocket stuff. Yeah, I just need to stop saying that. That's really gonna make me sound crazy. But I just worded myself incorrectly or inappropriately to where it sounded weird, like I was saying earlier. But here we go. This is a bearish liquidity void. Jeez, took me a minute to get that out. Let's identify the range of the liquidity void. This liquidity void has multiple gaps. Well, really just two. One and one here. Okay. First candle of the first fair value gap would be this one. Last candle of the last fair value gap would be that one right there. So let's do this. Since this candle is opposing the direction of the liquidity void, which is bearish, in which this candle was bullish, you would want to highlight the close of the first candle. Okay, there you go. Right there. Or basically the point that highlights all the sell side delivery here. And since the last candle of the last fair value gap, if I can get this here, since the last candle of the last fair value gap also opposes the direction of the liquidity void, you would want to mark the open of that candle, which will be right below there. There we go. So now we got everything. We totally have everything. Boom. we have the entire liquidity void in which it is such a huge magnet price. It literally gets filled ASAP. You can see, okay, it's like, all right, liquidity void's created. We got to refill this thing ASAP, in which it literally does it. Every other candle after that is digging into the liquidity void. So I think my point has been proven on liquidity voids are very, very strong, very, very significant. I should have did a couple trade examples on this, but I got some things coming in which I'm probably going to spoil it right now. These last episodes here, well, not episodes, not last episodes, but I guess you can say end of chapter lessons. There's 8 of them. Okay. This is where we're really going to put stuff together. I'm going to be recording these live, not like live streaming them or anything, but I'm going to be recording them during live markets. So they might be like hour-long recordings, 2-hour-long recordings, stuff like that. And we're really going to put all these concepts that you learned so far together and basically just put it together in a sense of I won't have to show you how to put it together no more. You would know how to put it together and use it as a whole. Because that's what this whole mentorship is. I'm teaching you everything about ICT concepts. And this is where you're really going to solidify the top down analysis and concept infusion, putting everything together. So you really gain some good analysis and good insight out of the market. This is really where we're going to do that at. Anyway, this is the end of what is this, episode 42? Pretty long episode, but very insightful one of the ICT Mastery Mentorship. I've been talking for 28 minutes. You can probably hear that I'm running out of breath, so I'll be in this episode here. Good luck and good trading.